Welcome to Philosophy of Action, part 2 of money, power and the financial system. This time I want to talk about what would be better. In the first part I argued that money is not just a thing. It is a form of abstract compelling force, a socially recognized claim on labor, resources and future production. And I argued that the modern fiat-credit system has become dangerous because it can generate more and more abstract claims, and more valuations, and more internal financial complexity, without remaining sufficiently tied to the material economy underneath it. So the obvious question is, what would be better? The first answer is what I do not mean. I do not mean that we should simply go back to a naive gold standard and pretend all problems will simply disappear when we go back to the old ways. Gold can constrain discretion, yes, but a hard gold standard is also rigid, vulnerable to reserve pressure, and poorly suited to a modern economy with large payment systems, banking structures, and credit needs. So the answer is not to romanticize the past. The second thing I do not mean is that we should just keep the current system and hope that better people will manage it. I do not think that is enough. The structure itself matters. A system that can continuously multiply claims through credit expansion and then politically defend the resulting valuation is not just occasionally mismanaged. It is structurally biased towards drift, distortions and over-abstractions. The Bank of England's own description of modern money creation makes clear that most money is created through lending, whilst BIS and IMF work shows how credit and asset prices can reinforce each other in boom-bust cycles. So the real goal is not gold and not more fiat. The real goal is this: to redesign the monetary system so that money remains useful as an impersonal coordinating force, while being more transparently disciplined by real production, real constraint, and real public capacity. In other words, allowing it to represent the real economy once again. That means, in my view, moving towards a real anchor monetary regime. What do I mean by that? I mean a system where money is still abstract, still transferable, and still usable for large-scale exchange, but where its issuance, stability, and long-run valuations are no longer allowed to float too freely away from the material economy. That anchor does not need to be a single metal. In fact, I increasingly think that relying on gold alone misses the deeper point. Gold is useful because it's durable, tradable, and hard to fake. But gold is not the economy. It is not electricity, not water, not transport, not housing, not food logistics, not industrial capacity. So a serious modern solution should probably think in terms not of one magical reserve asset, but of a layered anchor. I think a better system would likely have 3 layers. The first layer is a reserve and credibility layer. This is where harder assets still matter. Gold may still play some role here, not because it is sacred, but because reserve assets need to be durable, widely recognized and outside the direct liability structure of any one private institution. But this layer is not meant to represent the whole economy. It is there to impose discipline and provide confidence. The second layer is a real economy reference layer. This is, to me, the more important innovation. The currency should be judged against a transparent basket of socially necessary, measurable outputs and services. Things like electricity, drinking water, public transport, perhaps a housing service proxy, and perhaps some basic digital public service. Not because everyone should line up and redeem their cash for liters of water and train rides, but because the monetary system should be institutionally measured against the economy it is supposed to coordinate. In other words, instead of letting money float against nothing but policy credibility and asset market structure, you build a public reference index tied to measurable real output. The third layer is a limited public convertibility layer, not unlimited instant redemption, which invites classic run dynamics, but limited channels by which currency is tied back to real obligations or real services. That could mean tax offsets, utility credits, transport credits or scheduled redemption windows. The point is not to turn money back into warehouse receipts. The point is to stop money from becoming a pure internal financial token whose relation to reality depends entirely on central bank signaling and leveraged asset prices. And the only way this seems achievable is through some sort of actual fixed good convertibility rate, at least to a limited extent. So the key principle is this: convertibility ties money to goods by promise. A reference system ties money to goods by rule. And I think that the future solution is likely some mixture of the two, but with more emphasis on the rule than on the naive full convertibility. Now there is another major issue: how money enters the economy. And this might actually be the biggest one. This matters because the current system does not only have a valuation problem, it also has an issuance problem. If most money enters through interest-bearing bank credit, then the monetary system becomes deeply intertwined with leverage, refinancing, asset inflation, and rollover dependence. That does not make all credit evil, but it does mean that the growth of monetary claims is heavily shaped by the lending incentives of banks and collateral structures of asset markets. So I think a better system would reduce reliance on private bank credit creation as the dominant source of new money. If anything, such forms of creation should be wholly banned, if at all possible. That does not, however, mean abolishing investment finance. Economies still need long-term funding for housing, infrastructure, factories, and technology development. But it does mean drawing a sharper line between money creation and investment finance. Those should not be fused as fully as they are now. A better system would likely move towards something closer to a publicly governed money issuance, with private credit operating more as a genuine investment intermediary rather than as the main engine of broader money creation. The Bank of England's explanation, for example, of modern money creation shows why this distinction matters. Under the current setup, loans create deposits. My instinct is that new money should enter through channels that are more directly accountable to public rules and real production conditions, not primarily through debt expansion against collateral. That leads to the next question: how do you control the money supply? My answer is not by pretending we can do so without policy, but also not by letting policy float free either. I think the state should govern the money supply against real output anchors, meaning that the long-run expansion in money should broadly correspond to the growth of measurable productive capacity and basic socially necessary output, not one for one mechanically. Not €1 per kilowatt hour, that would be absurdly rigid. But the broad logic should be that money growth is justified when the economy's real capacity to deliver goods and services has grown. It should be restrained when claims are outrunning the capacity. That would mean using a published real economy basket as a policy benchmark, not just inflation targeting in abstract. Inflation targets alone are too thin. They do not sufficiently distinguish between healthy production growth, asset inflation, financial engineering, and the erosion of basic household command over the real necessities. So instead of asking only, is CPI inflation stable, or consumer price index, the monetary authority should also be asking how much command does the currency still have over the real essential outputs. How far are asset prices drifting from household income, rents, and productive use? How fast are financial claims expanding relative to measurable productive capacity? In other words, the anchor should be the real economy, not merely nominal. In other words, for example, you could look at total output of certain types of steel, goods, etc. in order to try to create more money based on the actual output of goods. So you have the basket, to which you're trying to measure the money supply anyway already, of actual goods being delivered in the economy, kilowatt hours, speed of internet connection, whatever people need to live, water, clean water produced, food, etc. And when those outputs increase, you increase the money supply in accordance with that. And only a set percentage increase can ever go above the actual production. So say we predict economic output growth of 10 to 20% next year, well then you can at most print, let's say 20 to 30% of extra money next year to allow the money supply to meet the actual growth of the economy, rather than just printing however much you think you might need to buy goods, or letting banks print through fractional reserve banking, e.g. being able to loan out more than they have inside the bank. Going back to the original point, in other words, the anchor should be the real economy, not merely nominal. But here there is a danger. If you make the system too rigid, you recreate the worst features of hard money regimes. If you say production slows, therefore money must contract immediately, then you risk making downturns worse. IMF work on fiscal rules and pro-cyclicality shows exactly the problem. Badly designed hard rules can deepen recessions rather than stabilize them. So the solution cannot be always a surplus in the good times, always contraction in the bad times. That's too crude. A better rule is something like this: discipline over the cycle, flexibility in the crisis. So that means that you have to tighten issuance of money supply in booms and the ability to inject liquidity in public money in downturns, and a credible mechanism to withdraw excess issuance later, mainly through taxation, fiscal restraints, or expiration structures rather than through endless debt rollovers. This matters because a monetary system does need elasticity. The question is not whether flexibility should exist, it is who controls it, how is it justified, and what anchors it to the material reality. So my current view is that a better system would combine a harder reserve discipline than today, a real economic reference basket, limited convertibility or tax credit redemption, limited convertibility or tax/service redemption channels, less reliance on bank credit created money, and counter-cyclical public issuance and withdrawal rules tied to real output rather than refinancing needs for asset markets. The counter-cyclicality, as explained earlier about tying your money issuance to real output, means that you're also issuing money to a certain extent anyway when there's a downturn, when there's less output, in order to create some liquidity in the market, but only when you see that there is an actual possible investment possibility. What I mean by that is that just giving people money in downturns doesn't actually increase the ability of the economy to necessarily bounce back. All it does is hyperinflate the currency. What's more important is to tie the money issuance towards aspects of the economy that are currently lacking money but are capable of both producing and demanding goods that need to be produced. That still leaves the banking question. What would banks do in such a system? They would still exist, but they should look less like creators of the money supply and more like genuine intermediaries of saved funds, public credit channels, or risk-bearing investment institutions. Transaction money and investment finance should be more clearly separated. In plain language, banks should finance projects, not quietly manufacture most of the social claim structure. What does this mean in more plain language? Banks should not be allowed to loan out more money than they have. So what about central banks? Well, central banks become simply the issuers of money to existing banks. In other words, most money that is printed should just flow directly into state coffers to be expended in whatever way is needed in accordance with the actual growth of the economy. So you can only print a certain amount of money based on the actual economic output of the economy, based on the basket we talked about earlier, with preset ratios. And then the central bank's only function is to use part of that money and lend it out to actual banks at central banking rates as we are using them nowadays. So you probably still need something like a central monetary authority, like a central bank, but its role should change. It should be less about continually backstopping asset structures and steering everything through interest rate effects on collateral and valuations, and more about preserving settlement stability, enforcing the issuance rule, and maintaining the currency's relation to the real anchor framework. Now, I want to be honest here. This is not a finished blueprint yet. There are still many open questions, and I can make a load of mistakes with this idea. But the key here is basically the idea of the basket, the financial basket by which we judge whether or not to print money or not. And how to design that basket, how much convertibility is enough without inviting runs, how to prevent external attacks in a globally fiat world, how to finance long-term investment without recreating the same leverage machine, how to maintain international competitiveness through transaction, and how to stop the rule itself from being captured. Those are real questions, but the broad direction I think is correct. The current system treats money as if trust, policy credibility, and financial plumbing are enough. They are enough to keep it running, yes, but they are not enough to keep it proportionate. A better system would treat money for what it really is, not a magical substance, not merely a symbol, but a public coordination instrument, a form of abstracted, compelling force that must remain answerable to the real world and its production of energy, transport, labor, water, housing, institutional capacity, and whatnot. That is the basic solution, not to return to primitive metal fetishism, not to blind faith in discretionary fiat, but a monetary order where abstraction is redisciplined by real economic output. That is where I think we need to go.